Welcome to the Deep Dive. We're here to give you, well, a genuine shortcut to becoming truly well-informed. We take your sources, boil them down, and really get to the core knowledge.
And today we're tackling a giant, Peter Lynch.
Absolutely. When you talk about legendary investors, I mean, the list isn't huge, right? But Peter Lynch, he's definitely on it.
No question. We're looking at the playbook of the man who ran the Fidelity Magellan Fund. And his record, it's just, well, it's legendary. A 29.2% average annual return for 13 years.
Which is what, basically double the S&P 500's performance during that time?
Consistently, yeah. And the scale is mind-boggling. Think about this. Lynch takes over in 77. The fund has maybe US $18 million.
Pocket change, relatively speaking.
Right. By 1990, when he steps down, $14 billion with a B.
Wow. So that just demolishes the idea that you can only get those massive returns with small funds.
Exactly. He proved you could scale that high performance. So our mission today, it's pretty straightforward. We want to pull out the essence of his success.
Just the bio, right? We want the actionable stuff.
Precisely. His 12 investment principles, how they actually work, and especially how this idea of local knowledge, how that can help you, the individual investor.
Okay, let's unpack the origin story first. Who was Peter Lynch before he was, Peter Lynch?
Well, he was born in 1944.
Yeah.
And life threw him a curveball early on. His father passed away when Peter was only 10.
Oh, wow. That's young.
Yeah. So he started working pretty early, became a caddy in his teens to help the family out financially.
And that caddying wasn't just about earning money, was it? It led somewhere.
It really did. That's where his first big investment win came from. He was at Boston College studying history, psychology, philosophy, interestingly enough, not finance.
Yeah, I noted that. History and philosophy.
He used savings from caddying, bought 100 shares of Flying Tiger Airlines, cost him about $7 a share.
Okay.
Later, it shot up to $80 a share. Boom. That profit basically paid for his education.
Incredible. And the Fidelity connection also came from caddying.
That's the story, yeah. His internship at Fidelity back in '66. Apparently, it helped that he'd caddied for Fidelity's president, a guy named D. George Sullivan.
It's amazing how those connections work sometimes. But you mentioned his studies philosophy logic. He thought that was more important than his MBA finance stuff.
You really did. He said it often. And you have to think about the context. Back then, the academic world was very focused on things like the random walk hypothesis.
Which basically says you can't beat the market, right? It's all random.
Pretty much. Or the efficient market hypothesis. Same idea, roughly.
Yeah.
But Lynch, using logic, looked around at Fidelity, saw these smart, disciplined people consistently making money through research.
And thought, hang on.
Exactly. He figured if people are actually beating the market through skill and hard work, then the theory claiming it's impossible must be wrong. Or at least incomplete. Observation trumped theory for him.
That's a really powerful way to look at it. And that mindset led to his big ideas.
Directly. First, probably his most famous one, invest in what you know. Really popularizing that concept of local knowledge.
Using your everyday experience.
Yeah. And second, the term he coined.
Yeah.
The 10-bagger.
Right, an investment that goes up 10 times. Like a home run is a 4-bagger in baseball.
He needed those 10-baggers. He knew, look, you're going to make mistakes. You'll pick some duds in a big portfolio. Those huge winners, the 10-baggers, they're the ones that make up for everything else. They have to. Okay,
so that's the background. Now let's get into the real meat here. The strategy, his 12 principles. Which ones really stand out for, someone listening who wants to apply this?
Well, number one is fundamental. Homework and understanding. He had this thing called the 2-minute drill.
Okay, what's that?
It's simple, but it's tough. If you can't explain why you own a stock to, say, an 11-year-old in just 1 minute,
then you shouldn't own it.
Bingo. You haven't done the real homework. It forces you to be crystal clear.
Okay, that makes sense. Then we get into the emotional side, which I think is where, frankly, most people trip up. Principle 2, accept volatility. And 3, ignore predictors.
This is crucial.
He says you have to accept that, I don't know, a 50% drop in a stock's price is just normal, that it happens. Is that really possible for most people, seeing half your money vanish?
It's incredibly difficult. The gut reaction is always panic, right? Sell. Get out.
Yeah.
But Lynch's point, based on watching markets for decades, was that trying to guess the corrections, trying to time the market, it costs you more in the long run.
How so?
Because you miss the rebounds. You sell low, maybe buy back higher, or you just stay out scared. That's why he had that famous quote. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves.
Wow. Okay. So the key is understanding the company. If you know the business is solid, the price drop is just noise.
That's the idea. If you've done that Principle 1 homework, the volatility shouldn't shake you out, which leads right into Principle 4, the flowers and weeds rule.
Ah, yes. Don't cut the flowers and water the weeds. Sounds easy.
Sounds easy, but think about what people usually do. A stock goes up, they get nervous, sell it, lock in a small profit, they cut the flower. Another stock tanks, they think, oh, it'll come back, and they hold on, maybe even buy more. They water the weed.
So how do you tell the difference? A great company having a bad month versus a genuinely bad investment.
You look at the business, not the stock ticker. Are the fundamentals still strong? Is revenue growing? Is debt manageable? Is the company still executing its plan? If yes, maybe it's a flower just temporarily wilted by the market.
And a weed.
A weed is when the company's story is broken. Management is failing, they're losing customers, the product is obsolete. That's when you sell, when the business itself is failing, not just when the stock price is down.
So the discipline is focused on the actual company. Okay. And that brings us back to that individual advantage idea. Principle 8, field research and local knowledge.
Yes, this is classic Lynch. Great investment ideas can literally come from walking around from your daily life. His Dunkin' Donuts example is perfect.
He was just a customer.
Pretty much. He lived in Boston, noticed the Dunkin' Donut shops were always packed. He saw it working firsthand. Then he went and looked at the financials, the numbers, and decided to invest.
The real-world observation came first.
Exactly. He really believed that you, the average person, can spot these trends on the ground, sometimes months or even years before Wall Street analysts, who are often buried in spreadsheets, even notice.
Wall Street chases, the individual discovers.
That's a good way to put it. Now, related to this is Principle 9, focus on competence. Stick to what you understand.
Makes sense. He avoided stuff he didn't get, like maybe complex tech back then or AI hype today.
Right. Stay in your circle. But that doesn't mean ignore everything new. It just means do the work to understand it before investing. And this connects to Principle 10, value versus price. Sometimes a high price isn't too high.
Okay, hold on. Let's unpack that. High valuation, like a high PE ratio, like Costco's, which is apparently sky high, like 55x.
Exactly. The price to earnings ratio, basically how much the market is willing to pay today for $1 of the company's current earnings. 55 times earnings sounds really expensive, right?
Yeah, it sounds crazy expensive.
But Lynch would argue, and many agree, that for truly great, dominant companies like Costco, that high price, the P, might be justified. Why? Because the market expects its earnings, the E, to grow consistently and reliably for a long, long time.
So you're paying a premium, but it's for predictable quality growth.
You got it. A fantastic company at a, let's say, fair or even slightly high price is often a much better bet than a mediocre company that looks statistically cheap.
So bringing it all together, he wasn't just a growth guy, wasn't just a value guy.
He was a hybrid. He really popularized the style we now call JARK growth at a reasonable price.
GRP. Okay.
Okay? You're looking for companies with strong growth prospects. That's the growth part. But you're also disciplined about not wildly overpaying for them. That's the reasonable price part. Finding that sweet spot.
Okay, so we've got the principles, the philosophy. Let's talk practical application. What does this actually demand from you listening right now? How do you use this stuff?
Well, Lynch was pretty direct about the effort involved. He said you should treat picking a stock like buying a house.
Meaning
You don't just spend 5 minutes online and click buy. You spend weeks, maybe months, doing research, looking at the neighborhood, checking the foundations, getting inspections. You do serious due diligence. Same applies to stocks, in his view.
That's a significant time commitment. What if you just don't have that kind of time? Weeks per stock.
He addressed that too.
Yeah.
Very clearly. If you don't have the time or maybe the inclination, the patience for that deep dive research, then you're probably better off just buying a low-cost index fund or an ETF that tracks the market. Simple as that. Active stock picking, Lynch style, isn't a casual hobby. It requires real work.
Okay, fair enough. But let's say you are willing to do the work. That core idea, invest in what you know. It sounds great, but are there limits? What about companies you just don't encounter, like semiconductor manufacturers or complex B2B software?
That's a really important point, the blind spot caveat. If it's not a consumer-facing company like, say, TSMC making chips, you won't see their products at the mall.
So invest in what you know doesn't apply there.
The principle still applies, but how you get to know it changes. You can't rely on just being a customer. Your local knowledge has to come from different sources,
Like what?
like reading their annual reports cover to cover, listening to their investor conference calls, understanding their competitors, their supply chain, the industry dynamics. The homework shifts from observing customers to analyzing financial data and industry reports. The effort is still required, maybe even more so.
So the definition of knowing broadens. It's not just consumer experience, it's deep business understanding.
Precisely. And underlying all of this, the real bedrock is patience, long-term thinking, discipline.
Resisting that urge to panic sell, resisting the urge to constantly chase the next hot thing.
Absolutely. Remember that quote about market timing? Trying to predict the dips often costs you more than just riding them out. If you've done the homework on the company, time becomes your biggest advantage. Let the winners run.
It really sounds like his success came down to this blend, that sharp, almost intuitive consumer observation skill, combined with really rigorous, disciplined financial analysis and just sheer patience.
That's a great summary. Instinct plus analysis plus discipline. Let's maybe wrap up with a few of his most memorable quotes, stuff that really sticks.
Yeah, let's do that. Good takeaways.
Okay, here's one that connects investing to something else entirely. Stock investment and weight loss, the final result is determined by patience, not brains.
Huh. I like that. It's about sticking with it. Okay, my turn. This one nails the research point. No wonder people make money in real estate and lose money in stocks. They choose a house often using months of time, but choose stocks using only minutes.
So true. And how about this one? A warning against jumping on bandwagons. If there's a stock I don't want to buy, it must be the hottest stock in the hottest industry.
Love that. Avoid the hype. Okay, and maybe one final thought, something about perspective during downturns.
Right. Lynch always pointed out, look back at history. Even after the absolute biggest crashes, 1929, the 70s, 87, whatever, the market eventually recovered.
It didn't just recover, but went higher.
Always went higher eventually. So
Yeah.
putting that together, maybe the final provocation for you listening is this. The next time the market gets choppy or you see a company whose products you genuinely use and love.
Remember Lynch.
Remember Lynch. And remember that the real challenge probably isn't spotting the opportunity. It's having the discipline, the patience, the sheer grit to hold on to it long enough for it to potentially become one of those 10 baggers. That's the hard part.